Value investing is a strategy where you focus on buying stocks that appear undervalued based on the underlying business's true worth, with the goal of holding them for the long term to realize that value. In this video, we'll explore what value investing and long-term investing really mean, why serious investors use a buy and hold approach, how it applies to the US stock market, and who this strategy suits best. Understanding these basics is crucial for US investors because it helps build wealth steadily without chasing quick gains, especially in a market that's often driven by short-term noise but rewards patience over time. Let's start by defining value investing in simple terms. At its core, value investing means looking at a stock not just as a ticker symbol or a price on a screen, but as a piece of a real business. When you buy a share, you're becoming a partial owner of that company. Value investors seek out businesses where the market price is lower than what the company is actually worth, its intrinsic value. This could happen because of temporary market fears, economic dips, or overlooked strengths in the business. The idea is to buy low, based on solid analysis, and wait for the market to recognize the true value. Long-term investing goes hand in hand with this. It involves committing to your investments for years or even decades, rather than trading frequently. The focus is on the growth of the business itself, not daily price swings. For example, imagine you own a share in a company that makes essential products people use every day. Over time, as the company expands, innovates, and increases profits, your share should grow in value accordingly. Long-term investing relies on the principle that good businesses compound wealth gradually, turning small initial investments into significant sums through reinvested earnings and steady growth. Now, why do serious investors gravitate toward a buy and hold strategy? Buy and hold means purchasing quality stocks and keeping them through market ups and downs, only selling if the fundamental reasons for owning them change dramatically. Serious investors use this because it minimizes costs like trading fees and taxes that eat into returns with frequent buying and selling. More importantly, it aligns with how wealth is built in reality, through consistent business performance, not timing the market perfectly, which is nearly impossible for most people. Studies of US market history show that the biggest gains often come from holding through volatility, as missing just a few of the best trading days can slash overall returns. In the US stock market, this approach fits particularly well because of the market structure and history. The US has one of the world's most developed stock exchanges, with thousands of publicly traded companies across sectors like technology, healthcare, and consumer goods. Regulations from bodies like the SEC provide transparency, making it easier to research and evaluate businesses. Historically, the S&P 500, which tracks major U.S. companies, has delivered average annual returns around 10% over long periods, including dividends. This growth comes from American innovation, economic expansion, and corporate profitability. For value investors, the U.S. market offers opportunities to find undervalued gems during corrections or sector slumps, then hold as the economy recovers and grows. But who is this strategy for? Value investing and buy and hold are ideal for beginners and intermediate investors who have time on their side, say, those in their 20s to 50s planning for retirement. It's for people who can afford to invest money they won't need immediately, allowing it to grow without panic selling during downturns. If you're someone who values research, patience, and logical decision-making over excitement, this fits. In the US, it's especially suitable for those using tax-advantaged accounts like 401(k), S, or IRAs, where long-term holding maximizes compounding without annual tax hits. On the flip side, this isn't for everyone. If you're looking for quick profits, day trading, or speculating on trends like hot tech stocks without understanding the business, value investing won't suit you. It's not for those who need liquidity soon, like someone saving for a house down payment in the next year, because short-term market drops could force sales at a loss. Also, if you can't handle seeing your portfolio value fluctuate, sometimes dropping 20% or more in a bear market, this approach might cause too much stress. Speculators or those chasing high-risk, high-reward plays like options or meme stocks should look elsewhere, as value investing prioritizes safety and steady progress. To illustrate, consider a hypothetical investor starting out. Suppose you have $10,000 to invest. A value investor might research a stable company in a familiar industry, like a food producer with consistent sales, low debt, and a history of profitability. If the stock trades below its estimated worth due to a temporary supply chain issue, you buy and hold. Over 5 to 10 years, as the company resolves issues and grows, your investment could double or more through earnings growth and dividends, far outpacing inflation. In contrast, a short-term trader might jump in and out based on news, incurring fees and potentially missing long-term upside. The U.S. market's volatility, driven by events like elections, interest rate changes, or global news, makes buy and hold a smarter choice for most, as it lets time smooth out the bumps. Another key aspect is how value investing encourages discipline in the U.S. context. With easy access to apps and online brokers, it's tempting to trade impulsively. But buy and hold forces you to focus on business fundamentals, revenue growth, profit margins, competitive advantages. This builds financial literacy, helping you navigate U.S.-specific factors like corporate earnings reports, which come quarterly, or economic indicators from the Federal Reserve. For beginners, starting with index funds that track the broad market can be a low-effort way to apply buy and hold principles. These funds own hundreds of stocks, providing instant diversification while capturing the U.S. economy's overall growth. As you gain confidence, you can select individual value stocks. Remember, the goal isn't to beat the market every year, but to achieve reliable returns over time. In the U.S., where capitalism drives innovation, patient investors have historically been rewarded. This strategy reduces emotional decisions, like selling in fear during a recession, which often locks in losses right before recoveries. As we move forward, keep in mind that value investing isn't about predicting the next big thing, but owning solid businesses at fair prices. It's a mindset shift from gambling to owning. We'll examine how the U.S. stock market operates at a beginner level. Understanding this foundation is essential for long-term investors because it shows why owning stocks can build wealth over time, despite short-term ups and downs. The market isn't a casino. It's a way to own pieces of real businesses that grow and create value in the American economy. First, what does owning a stock really mean? When you buy a share of stock, you're purchasing a small ownership stake in a company. Think of it like buying a slice of a large pie that represents the entire business. As a shareholder, you benefit if the company does well, through potential price increases in your shares or payments called dividends from company profits. For example, if you own stock in a company that makes everyday household items and more people buy those products over the years, the company's sales and earnings rise. That growth can make your ownership stake more valuable. In the U.S., companies list shares on exchanges like the New York Stock Exchange or NASDAQ, where buyers and sellers meet electronically to trade. Companies create value over time by using their resources to produce goods or services that customers want. Successful businesses reinvest profits to expand, opening new locations, developing better products, or entering new markets. This leads to higher revenue and earnings. Over decades, strong U.S. companies have grown significantly due to innovation, population growth, and economic expansion. For instance, a retailer might start with a few stores and end up with thousands nationwide, serving millions more customers. As earnings grow, the business becomes worth more, and so does each share. This is the core driver of long-term stock returns in the U.S. market. Why do prices fluctuate in the short term? Stock prices change daily based on supply and demand. How many people want to buy versus sell at any moment? News events, economic reports, investor emotions, or even global happenings can influence this. One day, positive earnings might push a price up. The next, broader market worries could pull it down. These swings are normal and often unrelated to the company's long-term progress. In the U.S., factors like quarterly earnings seasons, Federal Reserve announcements, or election news can cause volatility. But over years, these fluctuations tend to even out as the underlying business performance takes over. A key distinction for value investors is between market price and business value. The market price is what the stock trades for right now, what someone is willing to pay today. Business value, often called intrinsic value, is an estimate of what the entire company is truly worth based on its assets, earnings power, and future potential. Prices can deviate from value due to fear, greed, or temporary issues. For example, during economic slowdowns, solid companies might see their stock prices drop sharply even if operations remain strong. Long-term investors look for situations where price is below value, providing a buffer against mistakes and room for gains as the gap closes. To put this in perspective, consider a simple analogy. Imagine a farm that produces steady crops year after year. The farm's value comes from its land, equipment, and consistent output. But if bad weather news causes neighbors to panic and offer low prices for similar farms, a patient buyer could acquire one cheaply. Over time, as crops continue and weather normalizes, the farm's true productivity shines through, increasing its worth. Stocks work similarly. Short-term weather affects prices, but long-term harvests from business growth drive value. In the U.S. stock market, this dynamic has played out historically. Broad indexes tracking hundreds of companies have risen over long periods, reflecting overall economic progress. Beginners should note that while individual stocks vary, owning a diversified group reduces risk from any one company's issues. Another point, company management plays a role in value creation. Good leaders allocate capital wisely, reinvesting in growth, paying down debt, or returning cash to shareholders via dividends or buybacks. Poor decisions can erode value. Researching management quality is part of evaluating businesses. Short-term fluctuations also stem from broader forces. Interest rates affect borrowing costs for companies and attractiveness of stocks versus bonds. When rates rise, stock prices often fall initially as future earnings are worth less today. Economic cycles influence demand for products. Yet, resilient U.S. businesses adapt, emerging stronger. Understanding the difference between price and value helps avoid common pitfalls. Many chase rising prices, buying high during excitement, or sell low in panic. Long-term investors focus on value, buying when prices are reasonable and holding as businesses compound. For beginners, starting with this mindset shifts viewing stocks from gambling to partnering in American enterprise. The U.S. market's depth, thousands of companies across industries, offers opportunities to own quality businesses at varying prices. As we proceed, remember that market prices reflect collective opinions, which can be wrong short-term but tend toward fairness long-term. Patient ownership of valuable businesses has rewarded U.S. investors historically. Value investing rests on a set of core principles that guide decisions and help investors stay focused on facts rather than market noise. In this section, we'll break down these principles step by step. What intrinsic value means, the importance of a margin of safety, why company fundamentals outweigh daily headlines, and the critical difference between long-term thinking and short-term speculation. These ideas form the foundation for building wealth steadily in the U.S. stock market. First, let's explain intrinsic value in simple terms. Intrinsic value is an estimate of what a business is truly worth based on its ability to generate cash and profits over time. It's not the current stock price, but a calculated figure derived from factors like current earnings, assets, debt levels, growth prospects, and competitive position. Think of it as the fair price you'd pay if you were buying the entire company privately. For example, a company with steady sales, low costs, and a strong market position might have an intrinsic value much higher than its temporary stock price during a market dip. Value investors aim to buy stocks when the price is below this estimated intrinsic value, providing room for profit as the market eventually recognizes the business's worth. Next is the concept of margin of safety. This means buying a stock at a significant discount to its intrinsic value, creating a buffer against errors in your analysis or unexpected problems. If you estimate a company is worth $100 per share, but buy it at $70, that $30 difference acts as protection. Even if your calculation is off or the business faces temporary setbacks, you're less likely to lose money. In practice, this principle encourages patience, waiting for the market to offer bargains rather than paying full price or more. In the U.S. market, opportunities for margin of safety often appear during broad sell-offs, sector rotations, or company-specific issues that don't affect long-term viability. Why do fundamentals matter more than headlines? Company fundamentals are the measurable aspects of the business: revenue trends, profit margins, debt levels, cash flow, and return on invested capital. These drive intrinsic value over time. Headlines, news about earnings misses, lawsuits, or economic forecasts can swing prices dramatically in the short run, but often have limited lasting impact on strong businesses. For instance, a solid company might report slightly lower quarterly profits due to one-time costs, causing a price drop on negative news. A value investor checks if the core business remains intact and uses the dip as a buying opportunity. Relying on fundamentals keeps decisions rational and reduces emotional reactions to daily media coverage. This leads directly to the distinction between long-term thinking and short-term speculation. Long-term thinking focuses on where the business will be in 5, 10, or 20 years, its ability to grow earnings, maintain advantages, and adapt. It accepts short-term volatility as irrelevant noise. Short-term speculation, by contrast, tries to predict price movements based on momentum, charts, or upcoming events. Speculators by hoping to sell soon at a higher price, often without deep knowledge of the underlying business. In the US, speculation drives much of the daily trading volume, creating volatility that value investors can exploit. Long-term thinking has historically outperformed because good businesses compound value, and time allows mistakes to correct. To illustrate intrinsic value and margin of safety together, consider a manufacturing company with consistent demand for its products. Over years, it generates reliable profits and reinvests wisely. An investor might analyze past financial statements, project future cash flows, and arrive at an intrinsic value of $120 per share. If market fear pushes the price to $80, buying there provides a 33% margin of safety. As the business continues performing, the price tends to move toward intrinsic value, delivering gains without needing perfect timing. Fundamentals over headlines becomes clear during earnings seasons in the US. Companies report results quarterly, and stocks often gap up or down based on whether they beat or miss analyst expectations. Yet many misses stem from conservative guidance or short-term factors. A value investor digs deeper. Are sales still growing year over year? Is the balance sheet healthy? If yes, a price drop might signal opportunity, not danger. The long-term versus short-term mindset shows up in behavior. A long-term investor might hold a stock through a 30% decline if fundamentals remain strong, knowing recoveries follow downturns in the US market cycle. A speculator might sell quickly to avoid further losses, missing the rebound. Data from US market history supports long-term thinking. Portfolios held for decades capture the full upward trend of American business growth. Another practical angle: fundamentals help identify quality. Look for businesses with economic advantages, perhaps strong brand recognition, cost leadership, or network effects that protect profits over time. These traits support higher intrinsic value and make margin of safety easier to achieve during temporary weakness. Headlines can mislead by focusing on macro events like interest rates or geopolitics. While these matter, they affect all stocks somewhat equally. Superior long-term returns come from selecting individual businesses that thrive regardless of the environment. In summary for this section, these principles work together. Estimate intrinsic value through fundamentals, demand a margin of safety by buying below it, ignore headline noise, and commit to long-term ownership. This approach reduces risk and positions you to benefit from business growth rather than price guesses. As beginners build experience, applying these principles starts with simple checks. Does the company make money consistently? Is debt manageable? Does it have a clear path to future earnings? Positive answers, combined with a low price, signal potential value investments. These ideas aren't complex math. They're logical guidelines that prioritize business reality over market emotion. In the US context, where information is readily available through SEC filings and financial websites, anyone can learn to apply them. The long-term buy and hold strategy relies heavily on the power of compounding. Is the process where your investment earnings generate additional earnings over time. It's often described as earning returns not just on your original money, but on all the accumulated gains as well. In the stock market, this happens in two main ways: through price appreciation as the business grows, and through reinvested dividends. For example, suppose you invest $10,000 in a diversified group of solid US companies that grow their earnings at an average of 8% per year. After 1 year, you might have around $10,800. In year 2, that 8% applies to $10,800, not just the original $10,000, producing about $11,664. Over decades, this snowball effect becomes powerful. After 30 years at the same steady rate, that initial $10,000 could grow to over $100,000 without adding another dollar. The longer your time horizon, the more dramatic compounding becomes. From year 20 onward, the growth curve steepens sharply because the base amount is much larger. This is why long-term investing favors those who can leave money untouched for 20, 30, or 40 years. Common for retirement savers in the US using accounts like 401k, or IRAs. Historical data for the broad US stock market shows average annual returns around 10% before inflation over very long periods, including both growth and dividends. At that rate, money roughly doubles every 7 to 8 years. A $50,000 investment held for 30 years could realistically grow to over $870,000, assuming no additional contributions. Holding quality businesses is essential because compounding only works well when the underlying companies continue to perform over time. Quality means companies with durable competitive advantages, consistent profitability, prudent management, and the ability to grow earnings even during economic slowdowns. These businesses tend to increase their intrinsic value steadily, which eventually reflects in higher stock prices. For instance, a company that makes essential products with strong brand loyalty and efficient operations can raise prices modestly each year, expand into new markets, and reinvest profits wisely. Over decades, these small annual improvements add up to substantial value creation. In contrast, lower quality companies, those with high debt, cyclical earnings, or weak market positions, may experience periods of strong growth followed by sharp declines, interrupting the compounding process. Long-term investors avoid frequent switching because selling a quality business to chase something else often means giving up future compounding at favorable rates. Studies of U.S. market returns show that a significant portion of total gains comes from a relatively small number of outstanding companies held for long periods. Buy and hold works best when applied to these quality businesses because it allows time for management to execute strategies, for competitive advantages to widen, and for temporary setbacks to resolve. Market downturns, which happen regularly in the U.S., become opportunities rather than threats when you own strong companies. During recessions, quality businesses often gain market share as weaker competitors struggle, setting the stage for even stronger growth during recovery. Realistic expectations are crucial for staying committed. In the U.S. stock market, long-term investors should expect average annual returns in the 7 to 10% range over full market cycles, including dividends and after inflation. This includes periods of double-digit gains and years of flat or negative performance. For example, over any 20-year period since the 1920s, the S&P 500 has never delivered a negative nominal return. However, individual decades vary widely. Some deliver 15% plus annualized returns, others closer to 5%. Volatility is normal. A 20 to 30% decline occurs roughly every 5 to 7 years on average. Long-term investors view these as temporary and often add to positions if prices fall below intrinsic value. Expecting steady 10 to 12% every single year is unrealistic and leads to poor decisions. Instead, focus on the compounded result over your full investment horizon. Another realistic point, not every investment will be a winner. Even careful value investors will have some holdings that underperform. Diversification across 15 to 30 quality companies or through low-cost index funds helps ensure that the strong performers drive overall results. The goal isn't to pick only winners, but to avoid permanent losses and let the portfolio compound at a satisfactory rate. Taxes and fees also affect long-term results. In taxable accounts, frequent trading triggers capital gains taxes, reducing compounding. Buy and hold minimizes this drag. Using tax-advantaged retirement accounts available to most U.S. workers amplifies the effect by letting all gains reinvest tax-free or tax-deferred. Time horizon matters immensely. Someone investing in their 30s for retirement at 65 has 3 decades for compounding to work. An investor starting in their 50s has less time, so expectations must adjust accordingly. The earlier you begin, the less you need to save monthly to reach the same goal, thanks to compounding. To illustrate with a practical example, consider 2 investors. One puts $200 per month into a broad U.S. stock index fund starting at age 25. Assuming 8% average annual return, by age 65 they could have over $700,000. Another starts the same contributions at age 40. By 65, they'd have roughly half that amount, around $300,000, despite contributing for 25 years instead of 40. The difference comes almost entirely from extra compounding time. Quality and patience together create the environment for compounding to deliver its full potential. Rushing to sell during downturns or chasing hot sectors interrupts the process. Long-term investors succeed by staying invested through full market cycles. In the U.S. context, this strategy aligns with the economy's long-term growth trend driven by innovation, productivity gains, and population increases. While no future returns are guaranteed, the historical pattern supports planning around 7 to 10% real compound growth over decades. Dividend investing plays a key role in long-term wealth building by providing a steady stream of passive income from stock ownership. In this section, we'll cover what dividends are and how they work, the difference between focusing on dividend growth versus chasing high yields, and how dividends contribute to overall returns for patient U.S. investors. This approach fits naturally with buy and hold value investing, as it rewards owning quality businesses that share profits consistently. Dividends are simply cash payments that companies make to shareholders out of their earnings. When a profitable company generates more cash than it needs for day-to-day operations and growth, the board of directors can decide to return some of that money directly to owners. These payments are usually made quarterly in the U.S. For example, if you own 100 shares of a company that pays $1 per share each quarter as a dividend, you'll receive $100 every 3 months, deposited into your brokerage account. You can then spend it, save it, or reinvest it to buy more shares. Many established U.S. companies in sectors like consumer goods, utilities, and healthcare have paid and increased dividends for decades. The mechanics are straightforward. Companies announce a dividend amount and a payment date. On the record date, the company notes who owns shares, and eligible shareholders receive the payment shortly after. Most online brokers handle this automatically. Dividends are expressed as a dollar amount per share or as a yield, the annual dividend divided by the current stock price. A stock trading at $100 with a $4 annual dividend has a 4% yield. In the U.S., qualified dividends from companies held longer than 60 days receive favorable tax treatment, taxed at lower long-term capital gains rates rather than ordinary income rates for taxable accounts. Now, let's compare dividend growth versus high-yield strategies. Dividend growth investing focuses on companies that regularly increase their payouts over time, even if the starting yield is modest. These are often quality businesses with strong balance sheets and consistent earnings growth. A company starting with a 2% yield that raises its dividend 8% per year will see that yield on your original cost grow significantly over time. After 10 years, the effective yield on your purchase price could exceed 5%, and after 20 years, it might be over 10%. The key advantage is that growing dividends signal a healthy, expanding business, which also supports stock price appreciation. High-yield investing, by contrast, targets stocks with current yields of 8 to 12% or more. While the immediate income is attractive, very high yields often come with higher risk. They may indicate a struggling company where the stock price has fallen sharply, pushing the yield up, or a business in a declining industry paying out most of its earnings to maintain the dividend. If earnings drop, the dividend can be cut or eliminated, causing both lost income and a likely price decline. Many high-yield stocks are in cyclical sectors or have heavy debt loads. For long-term investors, chasing the highest current yield frequently leads to lower total returns and greater volatility. Dividend growth supports long-term wealth building in several practical ways. First, it provides rising income over time that helps combat inflation. A portfolio of growing dividend stocks can deliver increasing cash flow without selling shares, ideal for retirement. Second, reinvesting dividends accelerates compounding. Each payment buys more shares, which then generate their own dividends, creating a virtuous cycle. Historical studies of the U.S. market show that reinvested dividends have accounted for a large portion, often around 40%, of the total return of broad indexes over long periods. Third, Dividend-paying stocks, especially those with growth histories, tend to be from mature, stable companies that weather economic downturns better. During market declines, the ongoing income provides a psychological cushion, making it easier to hold rather than sell in panic. Companies with long records of dividend increases, sometimes called dividend aristocrats, those raising payouts for 25 plus consecutive years, have historically delivered competitive returns with lower volatility than the overall market. For U.S. investors, dividend strategies work well within tax-advantaged accounts. In a 401k or IRA, dividends reinvest without immediate taxes, maximizing compounding. Even in taxable accounts, the lower tax rate on qualified dividends makes them more efficient than equivalent bond interest. A balanced approach for beginners is to seek reasonable starting yields, say 2% from companies with sustainable payout ratios, dividends as a percentage of earnings, below 60 to 70%, and a track record of steady increases. This avoids both ultra-low yield growth stocks that may overpay for future potential and risky high-yield traps. To illustrate, imagine investing in a company paying $2 per share annually when you buy at $50, giving a 4% yield. If the company grows its dividend 7% per year and you reinvest, after 20 years your annual income from the same number of shares could exceed $8 per share, a 16% yield on your original cost, while the share price likely rises with earnings growth. Combined with price appreciation, total returns can be substantial. Dividend cuts do happen, especially in severe recessions, but quality companies with conservative payout policies rarely eliminate dividends entirely. Researching payout sustainability, looking at free cash flow coverage and debt levels, helps avoid most problems. Overall, dividend investing enhances buy and hold by turning paper gains into real cash flow and reinforcing discipline. It shifts focus from price movements to ownership of profit-sharing businesses. For long-term U.S. investors, a portfolio combining modest current yield with growth potential provides both income and capital appreciation, supporting financial goals without excessive risk. As you build experience, tracking a company's dividend history and earnings consistency becomes second nature. Many free online tools list dividend growth streaks and payout ratios for U.S. stocks. Building a portfolio as a beginner doesn't need to be complicated. In this section, we'll cover diversification in clear terms, basic risk management for new investors, and some of the most common mistakes beginners make in the U.S. market. These steps help create a solid foundation for long-term, buy and hold value investing while reducing unnecessary risks. Diversification means spreading your investments across different companies, industries, and sometimes asset types so that poor performance in one area doesn't drag down your entire portfolio. The goal is to own a variety of quality businesses whose fortunes don't all move in the same direction at the same time. For example, if you own stocks in both a technology company and a consumer staples company that makes everyday groceries, a slowdown in tech spending might hurt one holding while people continue buying food, helping balance the impact. In practice, beginners can achieve strong diversification by owning 15 to 30 individual stocks across at least 8 to 10 different sectors, such as healthcare, financials, energy, industrials, and consumer goods. An even simpler starting point is using low-cost index funds or exchange-traded funds, ETFs, that track broad U.S. market indexes like the S&P 500. One fund can instantly give you ownership in hundreds of companies weighted by size, providing built-in diversification without needing to research dozens of stocks right away. As you gain experience, you can gradually add individual value stocks to complement the index funds. Diversification works because not all sectors perform equally in every economic environment. During periods of strong growth, technology and consumer discretionary stocks often lead. In higher inflation or uncertain times, energy, materials, or healthcare may hold up better. Over full market cycles, this mix smooths returns and lowers the emotional strain of big swings in any single holding. Risk management for new investors starts with 3 practical guidelines. First, only invest money you won't need for at least 5 to 10 years. This allows time to ride out market declines without being forced to sell at low prices. Second, keep portfolio allocation appropriate to your situation. Most beginners benefit from 80 to 100% in stocks if they have decades ahead, gradually shifting toward more conservative holdings as retirement nears. Third, regularly review but don't overreact. Check your holdings once or twice a year to ensure the core reasons for owning them still hold, but avoid daily price watching that can lead to impulsive moves. Position sizing is another key risk tool. No single stock should represent more than 5 to 10% of your portfolio at the time of purchase. This prevents one bad outcome from causing major damage. For example, if you have $50,000 to invest, limit any one company to $2,500 to $5,000 initially. As winners grow over time, it's fine for strong performers to become larger portions. Trimming them back is optional unless they exceed 15 to 20%. Common beginner mistakes in the U.S. market often stem from emotion or misunderstanding how markets work. One frequent error is trying to time the market, waiting for a crash to buy or selling during declines out of fear. History shows that staying invested through full cycles produces better results than attempting to jump in and out. Another mistake is over-concentrating in familiar or hot sectors. Many new investors load up on technology or whatever industry they work in, believing they have an edge, only to suffer when that sector corrects sharply. Chasing past performance is widespread. Beginners often buy last year's top-performing funds or stocks, expecting the trend to continue, but markets rotate and yesterday's leaders frequently lag. A related error is ignoring costs. Paying high fees for actively managed funds or trading frequently erodes compounding over time. Low-cost index funds and occasional thoughtful trades keep more money working for you. Another pitfall is neglecting cash needs. Some beginners invest every available dollar, leaving no emergency fund. When unexpected expenses arise, they're forced to sell investments, often at inopportune times. A good rule is to maintain 3 to 6 months of living expenses in safe, liquid accounts before fully committing to long-term investments. Overreacting to news is common too. Headlines about recessions, rate hikes, or geopolitical events trigger panic selling. Yet the U.S. market has recovered from every past decline. Beginners who sell during fear often miss the subsequent rebound, which historically delivers much of the long-term gains. Finally, many new investors borrow money to invest, using margin loans from brokers, amplifying both gains and losses. A market drop can trigger forced sales, turning temporary declines into permanent losses. Long-term value investing works best with money you already have, not borrowed funds. To avoid these mistakes, follow a simple process. Start with broad index funds for instant diversification. Add to positions gradually using fresh savings, dollar cost averaging. Review fundamentals periodically rather than prices, and maintain an emergency buffer outside the portfolio. For U.S. beginners, taking advantage of workplace retirement plans like 401(k)s, especially if there's an employer match, provides free money and automatic diversification through target date or index options. Once comfortable, transitioning some assets to individual value stocks or dividend-focused ETFs builds on that base. Diversification and basic risk controls don't eliminate volatility, they make it manageable. The U.S. market will always have ups and downs, but a well-diversified portfolio of quality holdings reduces the impact of any single event. As you implement these ideas, remember that portfolio building is gradual. There's no need to invest everything at once or achieve perfect diversification immediately. Consistent saving and patient allocation over time produce strong results. Money management forms the backbone of successful long-term investing. In this section, we'll examine the difference between saving and investing, how to think about cash allocation for long-term investors, and practical ways to maintain financial discipline. These elements ensure you have money available to invest consistently while protecting against unnecessary risks in your wealth-building journey. Saving and investing serve distinct purposes. Saving is setting aside money in safe, liquid places like bank accounts or money market funds to preserve capital and earn modest interest. It's for short-term needs, emergency funds, upcoming purchases, or goals within a few years. Investing, by contrast, means putting money into assets like stocks with the expectation of higher returns over long periods, accepting volatility along the way. Saving protects your principal, investing grows it. Many beginners confuse the two and either keep too much in low return savings or invest money they might need soon, leading to forced sales during market dips. A practical guideline. First, build an emergency fund covering 3 to 6 months of essential living expenses in a high yield savings account or similar safe vehicle. Once that's in place, direct additional money toward investing if your time horizon is at least 5 to 10 years. For example, if you have $1,000 extra each month after expenses, keep enough flowing into savings to maintain your emergency buffer. Then invest the rest through automatic contributions to your brokerage or retirement account. Cash allocation for long-term investors should remain modest outside the emergency fund. Holding large cash balances waiting for better entry points often means missing market gains. U.S. stock market history shows that time in the market generally beats timing the market. A reasonable approach is to keep 2 to 5% of your portfolio in cash within your investment account for opportunities during sharp pullbacks, but avoid letting it grow much larger. The bulk should stay fully invested in quality stocks or funds, allowing compounding to work. Long-term investors benefit from dollar cost averaging, investing fixed amounts regularly regardless of price levels. This removes emotion from timing decisions. When markets are high, you buy fewer shares. When low, more shares. Over time, this averages out costs and reduces the impact of volatility. Automatic transfers from your bank to your investment account make this effortless. Cash needs change with life stages. Younger investors with stable jobs and decades ahead can keep minimal cash beyond emergencies. Those nearing retirement or with a regular income might hold 1 to 2 years of expenses in safer assets to avoid selling stocks during downturns. The key is matching cash levels to actual upcoming needs, not market predictions. Financial discipline involves practical habits that support consistent progress without relying on willpower alone. Start with a written plan, define your goals, retirement age, target portfolio size, and calculate required monthly investments based on realistic return assumptions. Use free online calculators to model scenarios. Review the plan annually, adjusting for life changes, but sticking to the core strategy. Automate everything possible. Set up direct deposits to savings, automatic investments to your 401k or IRA, and bill payments. This ensures money moves to the right places before you can spend it impulsively. Many U.S. employers offer payroll deductions to retirement plans. Use them, especially for any employer match, which is essentially free money. Track spending periodically, not obsessively. Once or twice a year, review major categories: housing, transportation, food, to identify leaks. Small reductions in discretionary areas can free substantial amounts for investing over time. The goal isn't deprivation, but aligning spending with priorities. Avoid lifestyle inflation as income rises. When you get a raise or bonus, direct at least half toward investments rather than immediately increasing expenses. This accelerates wealth building without feeling restricted. Debt management ties directly to investment success. High-interest debt, like credit cards above 10 to 15%, usually should be paid off before heavy investing, as the guaranteed return from eliminating that interest exceeds typical stock market expectations after risk. Low-interest debt, such as a fixed-rate mortgage below 5 to 6%, can reasonably coexist with investing, especially when stock returns historically outpace it. Separate accounts help maintain discipline. Keep emergency cash in a different bank from checking to reduce temptation. Use dedicated brokerage accounts for long-term money versus short-term savings goals. Rebalance thoughtfully but infrequently. If your target allocation drifts significantly, say stocks grow to dominate after a bull market, trim winners, and add to underweight areas once a year. This enforces buy low, sell high discipline systematically. Ignore market noise and predictions. Financial media thrives on daily drama, but long-term investors succeed by tuning it out. Check portfolios quarterly at most, focusing on whether your holdings' fundamentals remain sound. Build buffers beyond cash. Maintain adequate health and property insurance to prevent large, unexpected expenses from derailing plans. In the U.S., high-deductible health plans paired with HSAs offer tax advantages and serve as additional emergency resources. Finally, educate yourself continuously but selectively. Read 1 or 2 solid investing books per year. Follow reliable sources for company filings, and learn from experience rather than chasing hot tips. Discipline grows from understanding why you're following your plan. These practices, clear saving versus investing separation, minimal but appropriate cash holdings, and automated systems, create the conditions for steady wealth accumulation. They remove much of the emotional decision-making that trips up many investors. Over time, consistent application of these habits often matters more than individual stock picks. Money management ensures you have capital to deploy when opportunities arise and the resilience to stay invested through inevitable market cycles. We'll bring together the key lessons from the video and reinforce why a long-term, rational approach to value investing serves U.S. investors best. We'll review the core ideas step by step and close with practical next steps to help you move forward confidently. Throughout this video, we've focused on building wealth through patient ownership of quality businesses rather than chasing short-term market moves. We started by defining value investing and long-term buy and hold as strategies that treat stocks as partial ownership in real companies, not just prices on a screen. This approach fits the U.S. stock market well because of its depth, transparency, and historical growth driven by American innovation and economic expansion. We examined how the market works at a beginner level. Owning shares means participating in business growth. Prices fluctuate due to supply and demand in the short term, and the difference between market price and underlying business value creates opportunities for patient investors. The core principles of value investing: in estimating intrinsic value, demanding a margin of safety, prioritizing fundamentals over headlines, and thinking long-term rather than speculating, provide a logical framework that reduces emotional decisions and positions you to benefit from compounding. We explored the buy and hold strategy in depth, showing how compounding over decades turns modest investments into substantial wealth when applied to quality companies. Realistic expectations of 7 to 10% average annual returns over full market cycles, with periodic volatility, helps set achievable goals. Dividend investing adds a powerful layer by delivering growing passive income from reliable companies, supporting both total returns and psychological comfort during downturns. We distinguished sustainable dividend growth from risky high-yield chasing. Portfolio building for beginners centers on diversification across sectors or through low-cost index funds. Basic risk management like proper position sizing and emergency buffers, and avoiding common mistakes such as market timing, overconcentration, and reacting to news. Finally, sound money management, separating saving from investing, keeping appropriate cash levels, and building practical discipline through automation and clear plans ensures you consistently have capital to deploy and the resilience to stay the course. Taken together, these elements form a complete, rational system for long-term wealth building in the U.S. market. It doesn't require constant attention, genius-level predictions, or high-risk bets. It requires understanding businesses, buying them at reasonable prices with a margin of safety, diversifying sensibly, and allowing time and compounding to do the heavy lifting. The evidence from U.S. market history supports this approach. Broad indexes have compounded at solid rates over decades, and patient investors who stayed invested through every type of economic and market environment have been rewarded. Short-term speculation may grab headlines, but steady, fundamental-focused investing has built real wealth for generations of American investors. You're now equipped with a clear, practical framework. Start small if needed, perhaps with automatic contributions to a low-cost S&P 500 index fund in a retirement account. Then gradually apply the value principles as your knowledge grows. Progress comes from consistent action over years, not perfection on day one. If you found this video helpful, please give it a like to support the channel. Consider subscribing for more straightforward, educational investing content tailored to U.S. investors. And feel free to leave a comment below with any questions you have or topics you'd like covered in future videos. I'll read them and use them to plan upcoming content. Thank you for watching, and best wishes on your investing journey.